Let's be honest, watching the news these days can feel, well, like a direct assault on your wallet. All these headlines about inflation, tariffs, and crazy market swings, it's enough to make anyone anxious about their money. So today, we're going to cut through the noise and build a clear plan for navigating these uncertain times.
Yeah, it's the question on everyone's mind, right? And look, it's completely natural to be worried. When you see the major stock indexes bouncing all over the place and hear people talking about economic turbulence, it's easy to wonder, am I doing the right thing with my savings? And this isn't just some vague feeling in the air. This is real data. A recent University of Michigan survey that Forbes reported on shows consumer sentiment just plunged by 11%. That is one of the lowest readings we've seen in years. So if you're feeling nervous, trust me, you are definitely not alone.
So when that fear takes over, there's one asset people have turned to for literally thousands of years: gold. It's got this almost mythical reputation, right? The ultimate protector of wealth. But is it really the simple, shiny answer it's cracked up to be?
Okay, let's dive into this. And first, let's get our terms straight. What are we even talking about here? A safe haven, according to Investopedia, is basically an investment that's supposed to hold its value or maybe even go up when everything else is going down. You can think of it as the financial equivalent of a storm shelter. And the arguments for gold are pretty powerful. You can see the appeal. It's seen as a hedge against inflation because, unlike paper money, they can't just print more of it. It's a tangible asset. You can actually hold it in your hand, which gives people a unique sense of security. And historically, it often zigs when stocks and bonds zag, making it a classic tool for diversification. And this isn't just theory. Let's take a real-world stress test, the year 2022. It was a year of painfully high inflation. The S&P 500 stock index got hammered, cratering by nearly 20%. Even traditionally safe bonds fell almost 13%. And gold? It actually managed to eke out a small gain. This shows you exactly why investors run to it for shelter in a storm.
But if gold were the perfect solution, this would be a very short explainer, wouldn't it? The reality is way more complex, and financial experts are quick to warn that the glittering metal comes with its own set of pretty serious risks. So here's the thing about gold. It doesn't actually produce anything. A stock is a piece of a growing company. A bond pays you interest. A bar of gold, well, it just sits there. It generates zero income. Your entire profit depends on selling it for a higher price down the road. And when you add in storage and insurance costs for physical gold and its surprising volatility, the picture gets a lot murkier.
And this chart, wow, this really puts that long-term trade-off in perspective. Over 30 years, from 1990 to 2020, gold had a respectable 360% gain. But during that same time, the Dow Jones stock index soared by nearly 1,000%. For long-term growth, gold has historically been left in the dust by the stock market. And, it gets even more complicated because the decision of how you buy gold involves its own set of trade-offs. Owning the physical gold bars gives you a tangible asset with no third-party risk, but then you've got storage costs, and it's harder to sell quickly. A gold ETF is cheap and super easy to trade, but you don't actually own the metal, and you're just trusting the fund manager. There's no single perfect way to do it.
And that, right there, is the key question. If a single asset like gold isn't the magic bullet for protecting and growing your money through all this economic turmoil, then what is the right approach? Well, the answer that financial experts and decades of market history keep pointing to, it isn't a thing you buy, but a way you invest. The real safe haven is a strategy. And that strategy is called diversification. Vanguard defines it as a strategy that just mixes a wide variety of investments inside a portfolio. The whole goal is to reduce your risk so that a huge loss in any one investment doesn't sink your entire ship. It's a principle so fundamental that it's become one of the most timeless cliches, right? Putting all your money in one company or one industry or even just one type of asset, it's a huge gamble. Diversification is just the simple act of using many, many baskets. I love this analogy because it perfectly captures the spirit of modern diversification. Instead of trying to find that one magical stock, the needle that's going to make you rich, you simply buy the entire market, the haystack. That way, you're guaranteed to own all the winners without having to do the impossible task of predicting them. The reason diversification actually works
is because different assets react differently to the same economic news. They have what's called a low correlation. So, when fear is driving stock prices down, that very same fear might be driving investors toward the safety of bonds, pushing their prices up. Owning both helps to smooth out that wild ride.
Okay, so what does this haystack actually look like in practice? What are the tools and the building blocks you would use to actually construct a diversified portfolio? Well, first, you have your growth assets. These are the engine of your portfolio, the part that's designed to generate those higher returns over the long run. This category includes things like stocks from US and international companies, real estate, and funds like mutual funds and ETFs that hold hundreds or thousands of these assets all at once. Yeah, they carry more risk, but they are essential for creating wealth. Now, to balance out that risk, you have your stability assets. Think of these as the shock absorbers for your portfolio. This includes things like government and corporate bonds, Treasury Inflation-Protected Securities, and even ultra-safe options like CDs and high-yield savings accounts. Their job is to provide a reliable cushion and preserve your capital when the growth assets are going a little crazy. Now, you don't just hold these assets in a standard bank account. To get the most out of them, you typically place them inside a special container, one that's called a tax-advantaged account. The most common one that you can open up for yourself is an individual retirement account, or an IRA. And even within IRAs, you've got strategic choices. A traditional IRA lets you contribute with pre-tax dollars, which might give you a tax deduction today, but you'll pay taxes on withdrawals in retirement. A Roth IRA is the reverse. You contribute with after-tax money, so no deduction now, but then your qualified withdrawals in retirement are completely tax-free. It's a choice between paying taxes now or paying them later. Okay, we've gone from the problem of economic anxiety to the complex allure of gold, and we've landed on the powerful strategy of diversification. So what's the very first step to put this into practice and actually move from worry to action? It all comes down to a really simple framework. First, define your financial goals. What's the money for? What's your timeline? Second, be really honest with yourself about your risk tolerance. How much volatility can you actually stomach before you make emotional decisions? And third, you use those answers to build a diversified plan, a specific mix of growth and stability assets that is uniquely suited to you. There is no one-size-fits-all portfolio. In the end, building a resilient portfolio isn't about finding a magic asset that's going to protect you from everything. It's about building a plan that's resilient enough to withstand your own emotions and keep you on track. And that brings us to a final thought. What is one small, simple thing you can do today to get just a little bit clearer on your own financial goals? Because that clarity, that is the realest safe haven there is.